All right, y'all. Welcome to Counter Range Theory for Dummies. So I will be doing a new YouTube series on CRT, Counter Range Theory for Dummies. So you're gonna want to make sure that you subscribe to this because I will be posting at least a new series every single week. So I don't do this full time. So just so I can continue to put out good content with good value. I want to make sure that I take my time with everything that I'm doing and make sure all the edits and everything is good. So just so y'all can have, like I said, good value, learn a lot from this and get better. So CRT is the exact same model that I use to pass my prop firm account with Apex. As well, it'll also be the exact same model that I'll be using to get my first use payout as well too with Apex. So just make sure that you subscribe, like to my channel so you can be able to continue to see what the next series. And also another thing, I will be continue posting the trades that I take, so you'll be able to see that, see me taking my trades. I won't necessarily live, but you'll be able to see my trades, me recording my trades that I'm entering and getting out. So you'll be able to see me in drawdown, whether I lose trades or whether I win trades. So you're gonna be able to see it all. So just make sure that you like, subscribe, so you can be able to keep up with everything. So we'll go ahead and get right into this first introduction of this new series. So what we'll be learning, it'll be what is candle range theory, CRT, how to spot the CRT candle, the time frame and sessions, the daily flip entry model, using RSI plus CRT, and then also the common mistakes that people make, and finding support and resistance levels, combining time frames, advanced flip concepts, and as well the daily flip workflow. All right. So what is counter range theory? Counter range theory is the study of how price build traps and reverse within the range of a single candle or group of candles. In simple terms, CRT helps traders understand where price is likely to flip, direction, and which side of the candle is being targeted next. So as we can see on this image right here, you can see on this down closed bearish candle, we have the high of this red candle, and then we have the low. So right, we can see on the next candle that it took out the low of this previous candle, and then we can see how price overall closed bullish. So when, as you can see, it was closing very strong here, right? But then on the next candle, it closed very indecisive. And then on the next day, you see price open, retrace up, and then go up higher, take out the high of that range. So in simple terms, this is what the CRT model will look like. Now, this is just the reversal model, so there's a lot more to this. So this is the basic concept. So obviously, as we go more into the this PowerPoint slide, and as I do post more series, you'll be able to see more details of this and how you be able to understand how to catch reversals, how to use the same model even when price retrace and continue to go higher, and also how to use the counter range theory continuation model. All right, so how to spot the CRT candle. When the market is trending in one direction, CRT candle is the one that signals a possible flip in the momentum. Example, if price has been in a downtrend, then one day closed bullish or engulfed the previous day, then this shows the market hasn't finished selling, and is now shifting to buyers. From there, we expect the third day to be bullish, confirming the previous day was the range flip. In summary, the CRT candle is the transition candle. It ends one phase and begins a new trend. So as we can see here, we can see price was pushing up very strong, and then on the next day, it pushed up one more time, taking out the high, and then we overall closed bearish, showing you that there was going to be a shift going to the next momentum. So as we see here, that up momentum here, and we look right here, this is that same up momentum. So let's say this is like the daily time frame right here, right? Because I trade everything based off the daily time frame anyway when we come down to this. And you'll understand why as we go more deeper into this in this series. So as you can see, as we in this up momentum, we can see here that price was pushing up right here, right? Within a nice up momentum. And then all of a sudden price came down, and then price pushed up, taking out the high of this right here, and then came down making this shift here. So this is what we consider a breaking structure. And then price automatic retest back into here and start going lower. So what that looked like is that's this closing bearish with inside this range, and then on the next day we see price open, retrace back up, and go lower. So that retrace back up is actually this right here, price coming down, and then price retracing back up into here, making a fail high. So you see how it took out this high right here, and then as it came down, it made a fail high, shifting down lower, taking out this low. That's overall what counter range theory looked like and what it looked like on a lower time frame. So this could be the daily time frame, and then you could be on a 15-minute time frame, right? So in other words, this would be like your ideal entry. Then stop loss been above here, and then you just target the low, which is the range of this up momentum. All right, so the time and sessions of Tokyo that we'll be entering our trade. So this is for our entries only specifically. So from Tokyo session from 7 p.m. to 10 p.m. This is the time frame that I usually look for my trade. So the way how I prep my charts, I once the market closes at 5 o'clock, I really on Sundays I prep my charts for the whole entire week, and then throughout the week, once the market closes at 5 o'clock, I like to re-prep for the next day. But before 7 p.m. hit definitely. So around 7 p.m. between 10 p.m. is like our first entry target which I go for, because sometimes you can catch entries around this time frame too. And then we have London session 2 a.m. to 6 a.m. So if you don't catch an entry around Tokyo session, then your next session will be London, which is from 2 a.m. to 6 a.m. These are the time frame that we look for entries. And then if you don't get an entry between these time frames, the New York session will be from 6 a.m. to 10:30 a.m. If you don't find a trade after 10:30 a.m., we do not trade for the rest of the day. We wait for the next day and repeat. But majority of the time, you're going to find a trade entry either in Tokyo session or London session. I know a lot of people say, hey, Asian or Tokyo session or Sydney, whatever you want to call it, are not good time trades, but I promise y'all, like these two, Tokyo and London, has been the best entries that I found all my best entries at. Um, so let's go into the next one. As like I said, as we go in detail, you'll be able to see more of what I'm talking about as I go into more to the series. All right, so the daily flip entry model. So right here we're looking at this overall green candle, and what it's showing you is showing you what overall happened throughout the whole entire day. And then on the side, this is a 4 hour candle. And then so you see we have like the 15 minutes. So we're on a 15-minute time frame, but I'm overall seeing what happened throughout the day. So what happened was the previous day had closed bullish, and then you can see here we was in this nice little range, right? So price open here, came back down, retracing back down to this overall support level, and then what happened? We wait for the breakout, price retest on the breakout, and then that's your entry. So all we're doing, so the goal is, a lot of people will be trying to catch their moves. I'm going, you can catch your moves here, but me personally, it's way less riskier to trade the wick of the candle than to try to trade the body of the candle. So if the previous day closed bullish, then all we're looking for is for price to retrace back into, because that's the basic anatomy of how a candle operate. If the previous day bullish, wait for price to open and retrace down. And when it retrace down, usually price retrace between 0.10, 0.30, and 0.60%. Obviously, I will show more detail of that in my videos in the series. I can't do everything all in just one video. This is just an introduction of CRT module series that we're going to be getting into. So you can see how price came down, came between 0.10, 0.30%, and we made a clear breaking structure. Once you get that clear breaking structure on a 15-minute time frame, your entry here, stop off below here. And then guess what? You'll be targeting the highs. So this is more of a continuation model, but this is a basic anatomy of how we would do a daily flip entry model. And then how we use the RSI plus the CRT with the CRT. So this is actually more of this is not really a reversal. This is actually more of a continuation. Even on the 4 hour, you can see how we was bullish this 4 hour here, and then on the next 4 hour, price came down and pushed up higher. Even on the next 4 hour for that, it opened, pushed down, came up higher. It opened, pushed down, came up higher. That is the basic anatomy. No matter what time frame you use, that is the basic anatomy of how all candles operate. You expect price to open, retrace down a little bit, and you'll catch the reversal of that wick. So this is why I always say I only use the daily and 4 hour. So like, give you a little, well, I'll show that later. Okay, so RSI. This is where the RSI comes in handy at. On the RSI, you want to, whenever buying this after a price retrace, you want to kind of want to see price at least be at the baseline or either oversold. If it's not at the baseline or not at least oversold, you don't want to buy. Vice versa, because how it's going to look, let's say after expansion, right? You expect price to be overbought like how it is here, right? So let's say on the next day price open, then you kind of expect the RSI to push back down to the baseline. At the same time, when that happens, then you kind of already expect price to already be at a certain retracement, right? To reverse, to go higher. Like I said, I'll go into more details of this. This is just the, just the introduction. All right, so let's go on to the next video. All right, so the common mistakes. Even though CRT is simple, many traders make mistakes by focusing on the wrong candles or ignoring timing and structure. Y'all have to pay attention to the higher time frame, because look at it like this. Your higher time frame is your future. That lets you know where price is going overall. Your lower time frame is your present. It lets you know what price currently doing. So you want to wait until the present lines up with the future. How do we do that? We wait for it. It goes back to the video. The previous day was bullish, so we know our future is bullish. We on a 15-minute time frame, which is our present. We wait for price to make a break in structure to line up with that. Price breaks out, let us know that, okay, hey, we're still good. Price retrace back down, entry here, stop it below here, and that's our entry. That lines up with our higher time frame, aka our future. So you gotta make sure and also pay attention to the structure. Enter in too early. Let the market show you the shift first. Do not enter in, even though you have a bullish bias. Do not enter in unless you see a break of structure, because if or at least the 4-hour candle. Let's say if the 4-hour, after a huge expansion, the 4-hour candle closed bearish, right? You don't want to enter in, because you want to wait at least till the next 4-hour candle close bullish, because anything can happen for the next 4 hours. So like I said, I'll go in more detail that on as we start, going deeper into the series. And then not checking the RSI. If the RSI is overbought, right, that means price done already expanded too much. We need at least price. That means it's too expensive. We ain't trying to buy things when it's too expensive. We want to buy things at a discounted. So we want to see the RSI to go, or at least go back down. Same prime example. You see RSI is very overbought. So on the next day, if it would have opened right and it's overbought, we know not to buy yet, because we know price can potentially retrace down. So that's a prime example of what I mean by waiting for the RSI to confirm for you. And then also ignoring the trend. You gotta make sure you pay attention to it. Goes back to structure, because if you don't, and how do we figure it out? We figure it out by paying attention to the higher time frame. The higher time frame is our future. We look at the weekly, daily, and 4 hour to help understand our structure. All right, support and resistance level. This ties back into structure. So this is how we find our support level. So as you can see, price had a swing point here, so price came down, right? Breaking this swing high, breaking this. So once price broke this swing high right here, this automatically became our next support level. So what do? You wait for price to retest back into the support level, and then this is where you'll buy into. So why this is important? Because it's going to be that same model of how we wait for price to retrace down and go up higher. So you got to understand how to identify your support level. So once price made that break of structure, boom, you have your support level. That's your entry here. So guess what? The next swing high point is here. This is the next swing high. So once price broke that swing high, right, this will be your next support level. And then it just continue in that direction. We have this swing high, price here, and then you will mark this as your support level, wait for price to retrace back down into this, and then let it expand up higher. And then the cycle just continue to repeat. Vice versa in the downtrend market. So when you can see this, right, this is how you identify an uptrend. An uptrend is constantly seeing higher highs been taken out, followed by making higher lows. So this is how we identify an uptrend. This is also how we identify our support resistance. How do we identify a downtrend? Well, clear as day. You can see price coming down, goes up, and it breaks a lower low, breaking this low, going lower. It retests back up, going lower. So what this shows me, we're in the current downtrend. How do we find the support and resistance levels of this downtrend? Well, as price is going up, wait for price to break this swing low. It does, and then from there, that would be our support. When price taps in where it broke out at, then you look for price to go back down. Repeat the process. It took out this swing low. So guess what we expect? We expect price to come back into here. Sometimes it will do stuff like this and start showing you rejections here. If you see that, then obviously that's a little more advanced. But point is, overall, this is how you kind of respect price to come into the overall zone, breaks down, and then we look for price to retest back into this area right here, which is our next resistance level. So this would be your next resistance here, breaks out. This would be a resistance here. I think I've been saying support the whole entire time. I meant resistance. Price come at this be a new resistance level. As price break below this be your resistance levels. Look for it to go lower, taking out this low, and then as price tap back into here, this be your resistance level. So what this shows, this is in a down momentum. So this is overall how you find support levels. All right. Dang, I was trying to keep this video within less than 20 minutes. I mean, no more than 10 minutes. We have 14 minutes, but it's all good. About to be wrapping up soon. All right, so combining time frames. So your weekly, daily, 4 hour, these are the time frames you will analyze first. Why? Like I told y'all before, the higher time frame is your future. This lets you know your overall direction. And then your 15-minute and 5-minute, this will be the time frame for your entries. Why? The lower time frame is your present. Wait to align with the higher time frame, aka your future. All right, on to the next. All right, so these are advanced CRT strategies. Make sure, like I said, you like, subscribe to the channel, because like I said, I will be posting posting a video every Saturday, a new series. So this is just the introduction of the first series of the CRT for Dummies. So I'll be posting a series once a week, going in more details, actually looking at the chart, with y'all, so you can better see everything. So make sure you stay tuned with this. So now we're gonna go into more advanced CRT strategy, because sometimes they all do look different. Don't pay attention to these words right here, because I was on ChatGPT and trying to get AI to create me an image, and it got close to being something. But hey, so we can see here, price closed bullish right here, so we're in an up momentum, right? And then on the next candle, we can see price took out this high. So let's say if this was a daily time frame, because I do everything based on the daily. That means this day was bullish right here, right? This day was bullish, right? Which is fine. So you can make money off of this, right? Usually when you see something like this, usually you will expect price to continue to, retrace down and go up higher. This is why I say you have to wait for your breaking structure, because a lot of time when this happened, it's in RSI too. The RSI is gonna help you understand when price is overbought and when price getting ready to flip. So you can see here after this right here, right? Price open, pushed up, took the high out, and then dropped below, right? That was a clear indication that we was gonna be dropping. So what happened? What that looked like? It looked like price on the lower time frame. It's gonna look like price taking the high out, shifting down, pushing back up, retesting back into the resistance, and then going lower. That's this right here, pushing back up into it, coming back to the opening, and coming right back down. Same thing here. You can see here how this one look a little more different, kind of similar, but the body of it is different. So you can see with an up momentum. Then on this day, took out this high, then came down, pushed up and closed here, and then on the next day we pushed up and then closed, right? Similar with this one here, we can see how it's a fell high. So you can see how price was bullish. It made a fell high. Instead of taking a high out, it made a fell high, came down, took out the low, close. So then therefore we expect the next day to be bearish. So price pushed up and then came down. What they look like on the 15-minute time frame, it fell high, then price came all the way down, we trace up. See, because sometimes price don't come back to the zone. So you gotta know. So this is why we do our percentages. So the whole point of this is why I do have my percentages and wait for after when it retraces into them percentages levels, which is part of the daily flip module. Wait for that break of structure, and then you'll know. But obviously I'll do more in details of that on another series. And then obviously same thing, price made a equal high, a fell high, and then price kind of retraced here instead, so it kind of pulled back and then went lower. So this is just one. And then sometimes the candle might close within the body of it. It might not even be a wick. It might just be a small red candle within the body of it, and then price might just come back to the opening and then push down. So I just want to show y'all the difference, and then sometimes show y'all the different scenarios of what CRT strategy can look like. Now this is just the reversal method. You're gonna use the same module even when price retrace too, not just for reversal. You can use it for retracement and reversals. And then the last one that I have not showed y'all yet, which is how to do it off of a continuation. I will go in more depth with that in our series as we go on. So again, make sure you subscribe, like if you've been finding value in this content so far, and make sure you comment on what you want to see too. And what could be better. Like I said, this YouTube channel is strictly for y'all to give a lot of value, to be authentic, and just show you that even starting from the bottom, you can really get somewhere. So make sure y'all follow my journey. And then obviously the daily flip workflow. This is the last PowerPoint. The daily flip workflow overall is just going to the weekly, seeing if the weekly close bullish. Are we in an uptrend or a downtrend? And did the weekly candle close bullish? Boom, it closed bullish. Now we're going to the daily. Are we in an uptrend, downtrend? Let's say it's in an uptrend. Okay, boom, we're in an uptrend. Did the previous day close bullish? Okay, cool. The previous day closed bullish. So from there, all we would do is go to the 15-minute time frame, put our retracement levels and put our support levels, and we expect price to retrace down, create that break instruction. That's our entry, and then take it off from there. That's our overall daily flip workflow. So if you did like the content and got value from this content, make sure you like, subscribe to my YouTube channel as well. And you don't want to miss out on the next series that I'll be posting. Like I said, I'll be posting every Saturday, once a week, and also throughout the week, I also will be posting me entering my trades. So y'all will be able to see. But that'll be on my short videos. I'll be on my shorts. So I post my shorts, and also make sure you watch also my community tab. I do post my community tab here and there, so make sure you look out for those as well too. And of that, I will see y'all on the next series. Peace. I appreciate y'all.